Good day, a good evening, good morning. It depends on what time you are watching this. So I currently don't have a tripod and things are going to be a little bit hard for me, but we are doing accounting equations. So yeah, welcome to Accounting with Sihle. This is my first time doing this, but with time, things will make sense. So don't leave now, you might learn a thing or two. So this is the question. Hopefully you take a screenshot and then we can move forward. This is the screen question. We're going to be focusing on the accounting equation. And the accounting equation is, actually, let me try holding this properly. Accounting equation is assets is equals to equity plus liabilities. Always remember the double effect, double entry effect. For every credit, there must be a debit. If you are still struggling with what grows on what increases on the debit side or what increases on the credit side, just remember this: debt and click. In debt, this is debit, expenses, assets, and debtors control. With click, it's credit, liabilities, income, creditors control. Control. That's just that. Dead, click. You will never go wrong as long as you know this. So now we are moving to our first question. Because I did say that we're doing an activity, and then if you have questions, you can comment down below and then I'll focus on that. Number one, it's consultation fees that are charged to a client an amount of 200,000. Consultation fees, it means that money is entering in the company and that is an income. Income affects what? Owner's equity. So we're going to be using this structure. It affects owner's equity. But remember, income increases where? On the credit side. And here it is increasing. So this is how it's going to be. They are delivered on credit and customers have to pay in 30 days. Transaction that happens on the 5th of January, the account that is going to be debited is account receivables. Or you can say debtors control. And then the account credited is sales or consultation fees. Because that is the service that they are busy with. And then asset increases, remember. Asset increases because account receivable is a current asset. And then also owner's equity increases because the sales increase owner's equity, like sales are seen as an income. Then we go to the 11th of January, whereby they purchase a new office equipment for 90,000 on credit. So we are gonna debit the equipment because our equipments are increasing, and then we're gonna credit accounts payable because we are increasing our creditors control account. So asset is going to increase by a 90,000 rand, while the liabilities are also going to increase by a 90,000 rand. The 15th of January, a customer paid an outstanding account of 150,000. So the company is receiving money. A debt is being cleared. Bank is going to be debited, and account receivables is going to be credited because now they are paying it, so the account receivables are decreasing. And then asset is going to increase by 150,000 while it also increases by 150,000. Remember, our account receivables are a current asset and they're decreasing now. So that's why we say that it's gonna, like, asset is gonna decrease by 150,000 while the asset also increases by 150,000 because the bank now the bank account like increases. 16th of January, we issued a credit note to a customer for 1,000 rand to resolve an issue with the client not happy to report to a report delivered late. First of all, the account that will be debited is sales returns, and account receivables will be credited. Remember when they were like getting our service for credit, the account receivables increased. Now because we're taking now because they are returning our item, we have to like reverse the transaction. That's why now account receivable is being credited. Our assets are gonna decrease. Our assets are gonna decrease by 1,000 rand because now account receivables is decreasing. And then another thing is that equity is also going to decrease by 1,000 rand because now we're not going to get the money. And had the customer paid the debt, like if they were happy, then our owner's equity was going to increase. Paid electricity of 5,000 rand and rent for the business premises. This is an expense, like money is going out. So we're gonna debit electricity and rent paid, and we're gonna credit bank because money is moving out. Bank is an asset, and bank decreases where? On the credit side. So assets are gonna decrease by a 20,000 rand, and then our owner's equity is also going to decrease by 15,000 rand for the electricity and 5,000 rand for the rent that has been paid. No, vice versa actually, sorry. 5,000 for electricity and 15,000 for the rent paid. Out of an irrecoverable debt, that won't be paid anymore. I'm going to debit irrecoverable debt and credit account receivable. Remember when they took the debt from us, it increased. Now that they are not paying it, we have to decrease it because it's money that we are not going to get. So now assets are going to decrease by 2,500 while owner's equity also decreases by 2,500. Paid salaries of 800,000, and that is an expense. An expense increases on the debit side and decreases where? On the credit side. In this case, expenses are increasing. The account that is going to be debited is salaries, and we're going to credit bank since money is going out of the company. So assets are going to decrease by an 800,000 while owner's equity decreases by 800,000. The reason why expenses affect owner's equity, if you may ask yourself, is because income and expenses affect owner's equity. So if an expense, like a transaction that involves an expense happen, we're going to focus on the owner's equity. If a transaction that involves income happens, we're also going to focus on owner's equity. Income increases owner's equity, and then expenses, they reduce owner's equity. That is why with the expenses, we had to put the 800 under the decreased side of owner's equity because they are decreasing the owner's equity. Like the capital of the company is decreasing since we are paying.